In the last Monetary Policy Committee meeting held on the 9th of October, the Reserve Bank of India kept interest rates unchanged at 6.5%. Now we have a better understanding of why there was no rate cut and where that decision to keep rates unchanged came from. The RBI has released the minutes of that Monetary Policy Committee meeting. During that meeting, Governor Shaktikanta highlighted the country's urgent need to avoid another bout of inflation. He emphasized that keeping inflation under control is essential to sustaining long-term economic growth. Inflation, which erodes purchasing power by increasing the cost of goods and services, can have severe economic consequences if left unchecked. High inflation can lead to rising interest rates, reduced investment, and a potential slowdown in economic activity, making it difficult for both consumers and businesses to plan for the future. At the heart of the debate during that Monetary Policy Committee meeting was the decision to maintain the current policy repo rate at 6.5%, a rate that has remained unchanged for the 10th consecutive time. Governor Das voted to keep the rate stable, stressing that the current approach should remain flexible until inflation durably aligns with the Reserve Bank of India's target of 4%. He argued that monetary policy can only support sustainable growth if it also ensures price stability. Inflation in India has seen a near-term uptick, especially in food prices, creating uncertainty about when inflation will return to its target range. However, Governor Das and other Monetary Policy Committee members expressed optimism that inflation would begin to align more closely with that 4% target towards the end of the year and early next year. By maintaining the status quo on policy rates and adopting a neutral stance, as opposed to the previous withdrawal of accommodation, the Reserve Bank of India aims to monitor inflationary trends while avoiding policy decisions that could destabilize the economy. Now, Deputy Governor of RBI, Michael Debabrata, echoed Das's view, advocating for a gradual wait and assess approach. He suggested that rushing to cut rates could lead to policy errors with significant costs. Rajiv Ranjan, RBI's executive director, also supported maintaining the current rate, citing India's resilient growth and the need for clarity on external uncertainties before making changes. While most members agreed on maintaining the rate, one external member, Nagesh Kumar, advocated for a 25 basis point rate cut. He argued that inflationary expectations are now anchored and that an interest rate cut could revive flagging industrial demand. Despite this, the majority agreed that the current policy should remain stable to safeguard the economy from further inflationary risks. The Monetary Policy Committee's decision to hold rates reflects a cautious approach to avoid the detrimental effects of inflation while continuing to monitor economic conditions closely.